I mean,
Good to
given
see
your
you, Scott.
experience covering this space, what do you do with a stock like NVIDIA and some of these other chips now? Jonathan Krinsky just putting out a note, by the way, from BTIG right before we came on that said, quote, semis remain heavy.
Yeah, I mean, look, our view since early February was to go underweight the Mag 7. I'm still concerned about, the recent sentiment to the positive. You've seen some firms try to upgrade the Mag 7 again. The fact of the matter is the capital spending went up, the valuation is not that compelling, and the risk went up because there's disruption potential that's higher. So I think you have to be a little bit cautious heading into April earnings. I think after April earnings, it could change. What I'm looking for is any sign, Scott, that a stock misses and doesn't go down. If you think about the last couple of weeks, like every stock that missed got killed. So nobody could say, hey, the misses are in the price and we're all set. We haven't seen that at all. Micron, Nike, down the line. So I think there's a real chance for the first time in maybe 2 years, we could see some negative pre-releases the first week of April or disappointingly bad guidance. So I think you have to be a little bit cautious, at least heading into the first couple weeks of April.
You make the case in your notes that you really want to get bullish. I mean, we've had a 10% correction, and now we've had a 5% bounce, notwithstanding today's obvious decline. But you suggest it's just too early. What's the principal reason you think that it's too early?
I think it's that, the economy is clearly slowed. I don't think it's a growth scare. I think things have slowed. And, most of the big firms, economists have taken down their GDP. But we haven't seen that earnings reduction yet. We know it's coming. And we haven't seen companies missing, like I just said, act okay. I mean, we know, you and I both know that all clear sign is you get like a cyclical business that misses and the stock acts fine. You sort of feel like, all right, that's the end of the bad news. We haven't seen that at all. We've seen missing asymmetrically, you get killed. So I'm looking for any signs of a reset to earnings that are treated well by the market. I think, there is a fundamental bull case forming, Scott, and I just worry that everyone believes it's going to get better in the second half of the year. Everyone thinks we'll get into, taxes and regulation, and we'll get back to that growth trajectory that made people euphoric in November, and we'll get on the other side of this tariff stuff. My own personal opinion is I don't think the tariff stuff is going to be that bad. And the reason I say that is just because, particularly with Canada and Mexico, our economies are 10 times as big as theirs. So if we do things pro rata, it affects them 10 times as much. So there'll be some, stuff in the, words. But the reality is I don't think it'll be that extreme and hit that many companies for that long. So
but you didn't mention China. You didn't mention China, right? That's the biggest tariff issue risk out there, isn't it? I mean, Canada, Mexico, I get it. There are serious issues involved with both of those countries and tariffs and the impact it would have. But, I mean, it's China that we really have to worry about on the impact from more punitive tariffs, no?
I think that's right. And I think it's a little hard for me to know the answer, which is one of the reasons, we got cautious at the beginning of the year saying I didn't think all this policy was in the price and why we thought there'd be a volatile and down market. I'd like to be optimistic and say it's not going to be that nefarious, but I'm not sure, which is why I think the market is, still has a volatile, short-term path. I did some interesting work recently, though, which showed that if you look at the last 20 times the market went down 10% or more, and you looked at what happened to 3 months after, 19 of those 20 times technology worked. So if you want to get bullish, I just don't see how you can get bullish without adding to tech. And you can see today, like it's still a little too early to go back to that playbook. And that was our view. Our view was if you want to get bullish on tech, but we don't think you should do so. I think today's a good example of that. It's just too early. You got to feel good about the tech tape, inventory, revenue growth, all those major KPIs. And I don't think you're going to feel great about it until at least we get halfway through April earnings.
How closely are you watching interest rates and the fact that they've been really staging this almost stealthy move higher? You look at the 10-year pushing 435 today. We don't really want to be having that conversation again if we get near 4.5. And, the next thing is 5% possible because of tariffs and potential impacts?
I think it's tricky. If I try to read what Mr. Bessent's saying, I think he wants housing to get better and he doesn't want the long end to back up. It's hard for me to see how the 10-year doesn't go lower if we have some recessionary fears grow. So without the recessionary fears, it's harder to make that argument. At the current moment, I just don't think the Fed cutting is going to be that bullish for equities. So I think what we need to believe is that we're in a soft patch economically, a soft patch because consumer confidence is weak, because CEOs are sitting on their hands. And when we get through this uncertain period and talk about more pro-growth initiatives like taxes and regulation relief, then we get a growth trajectory and we look back and say, this was a great buying opportunity. That could be true, but I don't think it's the right time until I get more confidence that, the Q2 guidance isn't a mess.
You are, though, a don't fight the Fed kind of a person. I mean, we've talked about this a number of times. So even though it sounds to me like you're suggesting, okay, rates are going down for the wrong reason, the Fed would be cutting for the wrong reason because they have to, because the economy is getting weak, as you suggest. If I wouldn't fight that before, why would I fight that now?
So, look, that's an awesome question. I think this is the nuance, and I think every cycle it changes a little. What did we learn at the end of 2022 into 23, right? If you and I were geniuses, we would have been short Meta and Tesla and NVIDIA like crazy in 2022, covered our shorts and got max long Jan 21st, 2023. Why would we have done that ex post? Because the Fed was closer to being done hiking than they were starting, right? And so if I take that same logic that at some point in the cutting cycle, there's less oomph behind the cut and now it's more like worrisome, the debate I think about fighting the Fed will be, are we close to that point now where if they're cutting now, it's not just like stimulative and awesome from multiples, they're cutting because things are deteriorating, and then maybe that's like not all in the price yet. And I think that's the investment controversy.